Welcome back if you're joining us in our fourth week of broadcasting on webinars to keep you updated and keep you in the loop on what's going on. A lot of you have asked us in our previous webinars can we talk to the marketplace? Can we talk about what's going on? Can we have a forum for that? So we've put that on today, and there will be other opportunities to pick up particular themes. So today is literally going to be a high-level view of the market, and what sort of mindset should we have in these unprecedented conditions? What do we need to do? What do we need to review? How do we need to replan based on where we are? In terms of housekeeping, obviously, whenever we talk about investments at the marketplace, obviously we have to do the health checks. This is our health check, our disclaimer. Please don't make investment decisions based on the call today. If you want to take steps going forward, then please give us a call, contact us, and we can take you through that. Okay, so we're going to just really helicopter into three key areas. We're going to look at the most amazing year ever, 2020, as it's going to turn out to be, the market outlook, an update on Q2, and some generic pension investment strategies, and really touch on the mortgage markets. I know some of you are very interested in what that's going to mean. March, unbelievable March in terms of, you're looking at 10 to 12 million unemployment in the US. The oil issue, the oil challenges have almost been eclipsed by everything else. But if we weren't in this COVID crisis, then big front page would be the oil conflict with Saudi Arabia and Russia and the crashes and a whole range of stuff going on there. In this really shocking time, we're definitely seeing credit gradings being adjusted on countries and companies. Pressure now for 50% of companies to cut dividends. That's going to have a real impact if you're an income investor and you've got your traditional approaches going on at the moment. Real interesting thoughts around what you should be doing there. Of course, the damage to the consumer confidence that this has created, this sudden, intense shock, is definitely going to outlive the impact of the virus. But there's going to be opportunities in this time which we need to take measure of, and we'll touch on those as we go forward. Massive impact in the property space. There's a freezing, pausing of the marketplace, and Phil's going to touch on what that may mean for some of you as we go forward. Certainly, the first quarter is going to be one of the worst quarters ever. We've seen violent sell-offs in March, dramatic market movements, seesaw with some recovery, only to then dip again. So the theme for this quarter and the next quarter is going to be volatility remains high. And there is no certainty that we're in the lowest point yet in equities, despite some of the rallies that are going on. We'll only know as time passes. The reality is, this is a finite situation, and we will be coming through this. But of course, it's majorly impossible to time the market. In fact, anyone who thinks they can time it, is clearly deluded. It's not timing the market that's key; it's time in the market. And Phil and Chris and I will sort of have a chat around that as we go forward. But a lot of impact through these unemployment record numbers in the US. In the UK, clearly the 1 million benefit claims record rise, the huge SME distress that's going on, and the skies being closed. The major positive here in this chaos is the government stepping up. Is that not only is the UK government stepping up, but the European and global governments are stepping up with significant economic measures, which gives us confidence and hope that this, although it's going to be a traumatic and dramatic season, we will weather and come through. So retail, we all know we can't go shopping, so that's going to have a massive impact on companies, hugely distressing. The oil price war, the global lockdown, triggered collapse in oil demand by 30%, 18-year lows in terms of the Brent crude price from $70 in January to $30 in April, slightly over that today. And the G20 needing to step in to ensure that the energy sector is going to traverse and navigate these choppy waters. The 2.3 trillion Fed loan package clearly helped equity rallies back end of last week. And the Eurozone 500 billion rescue package on Thursday. All in all, Western government measures totaling $8 trillion in just weeks. What an amazing financial stimulus. So lots going on, lots to be aware of. So I think, quite clearly we're seeing, significant, unprecedented market movements. Chris, obviously you're in the firing line just like we are on this. What's your take, and what's your take to our clients who are investors in the market, and what's the high level view coming from 7IM on this?
Thanks, Stuart. Well, if I just start by looking backwards and then talk about what our view is going forwards, I think that's always the best place to begin. We've seen an event-driven sell-off. So the event in this case is the coronavirus and the perceived impact on commerce and society as a whole, as you touched upon. Shutting borders and keeping people inside their homes has a negative impact on economic growth, as we've quite clearly seen. Hairdressers, restaurants, pretty much everything is shut on high streets across the country. And in fact, you can extrapolate that out into pretty much internationally with a couple of exceptions. People buy less, sell less, and make less, which clearly has an impact on their value as businesses. But we think this is going to be a temporary shock. Not as short-lived as perhaps investors believed a month ago, but certainly not a permanent state of affairs. I think that's the question we're asked most often. Authorities around the world are moving in the right direction, I think, as you allude to, if not all at the same speed. Expert advice is being listened to, and populations are working together. Stopping the loss of human life is the priority, as it absolutely should be. Thus far, the actions we've taken to preserve our physical health, though, have not been positive for financial assets, which sounds like a crass statement, but just for the purposes of today and focusing on the actual numbers, talking through the first quarter of the year, UK equity is down 25%, US equity is down just shy of 20%, Europe down 21%, Japan 17.5%, emerging markets 18.25%, and so on. Pretty much across the board, risk assets, as we refer to them, have been sold off. So the lockdown is working to contain the virus, but its effects on the price of assets that we invest in are clear. I think just to get abstract for a moment, if I may, the best analogy I've seen for this policy and its potential effects have been that of a chap called Thomas Pueyo. He's an American commentator, if anybody's seen this, who describes the approach to dealing with coronavirus as the hammer and the dance. So bear with me as I try and paint a picture without slides, but we're currently in the hammer phase. So the idea is to crack down on the virus as much as possible. If the restrictions are tough enough, and our people then follow them, then case numbers should begin falling, as indeed we've seen in China, where at the epicenter of the crisis, Wuhan, people have actually started going back to work and trains are running and what have you. There is an end to this. If the virus then pops up again, then the rules will be tightened up again. And then it'll be up, down, up, down. We'll see a dance, basically, of measures to get our lives back on track while keeping the virus under control. I think the good news, though, is twofold. First, the heavier the hammer is applied now, the sooner the virus comes under control, hence all of the messages from the government around stay at home, protect the NHS, and the sooner the dance begins. I mean, we could be talking about a few weeks rather than months, depending, that is, on how you interpret the change in tone in the government's briefings that I think we've seen over the course of the past few days. Second, that same government has acted fast. Last month, the Bank of England cut rates to 0.1%. Rishi Sunak had only been Chancellor of the Exchequer for 6 weeks, but clearly understood that strong action was needed in order to limit the economic downturn. He's announced economic measures to support the incomes of working people, companies up to 5% of GDP. It's been shock and awe has been the approach, not like with the financial crisis, which many people have tried to draw tangents with, whereas a lot more pedestrian, I suppose, in their reaction. But more assistance will be forthcoming if that's not enough. But just continue with that hammer and dance. We won't dance forever. It'll be awkward. It's new territory, and working out how best to implement it will be very hard. But there is a but. Sooner or later, there will be an end game. And it'll take either two forms. One, a cocktail of drugs to help people cope with and recover from the coronavirus. Several are being tested and indeed look promising. They might materialise on large scale later on this year, depending on obviously how they get on with that. But the bigger one is a COVID-19 vaccine. Normally it takes many years to develop a vaccine, but there is such a global focus right now, and all those billionaires are lining up, obviously, from a PR perspective or otherwise, if you're being cynical, to get involved in this. And the experts actually think one might be developed by next year. Now, at last count, about 35 vaccines are already being trialled across the world. Hopefully one of them, fingers crossed, will be a winner. We'll just have to wait and see where all that's concerned. But we're hopeful about both of these outcomes, I think, as an investment house. Science, human ingenuity, and big budgets all combined together can do great things. I think for the time being, we've got to be realistic in talking about the quarter ahead, as you put on the screen. They're probably 6 months away, those measures, minimum. So for now, we're going to have to deal with the fact that economic growth numbers for the next few months are going to be absolutely ghastly. The worst since the 1940s would be our prediction, and looking at some of the analysts' notes. US unemployment, as Stuart's touched upon already, is at financial crisis levels. It's likely to continue to get worse. But I think if I could say that there is a silver lining here somewhere, and to try and look at that glass half full, there will be a bottom. We expect the downturn to be short-lived. It'll probably be followed by a strong recovery as well. And as investors, that's what we're spending a lot of our time thinking about at the moment. What is next? I think a useful way to gain perspective here would be just to say that the economy and the level to which it's going to contract will likely be a lot more than in 2008. But then the respective recovery, when it comes, will also be a lot quicker. And this is normally where all the analysts jump on and start trying to give letters of the alphabet as to what that recovery is going to look like. I'm not going to do that today, but I would say that based on our predictions and what it is that we're seeing and those of the other investment houses that we're in discussion with, we would expect mean reversion to come back quite quickly, certainly in historical context. And just, I suppose, to finish with, looking forward, as you might expect as an investment house, we've modelled a few different scenarios. You can never tell exactly what's going to happen. So what you try and do is look at the very positive, the good, the bad, and the very bad. And then you try and attribute how much weighting, if you like, you would put to each of those and how likely they are of occurring. So in terms of the very good, well, what does that look like and why? That would be strong profit growth and defaults limited, preferring equities from our point of view over credit, if that was the area we thought that was going to occur. And then your political and your policy bazookas, if you like, then end up working too well, pushing up growth and inflation accordingly. Inflation, obviously, with the oil point about the back and forth and the saving face between Saudi Arabia and Russia, it'll be interesting as well to see how that feeds through to numbers in due course. The good, so the next level down is that profit growth is patchy, but the default cycle is contained, at which point we would therefore prefer, say, credit over equities, if we were to choose between those two asset classes. And as the economic fallout is contained, market volatility would therefore be limited. And Stuart and I was touching a lot upon that earlier, and the fact that fluctuations, and we agree, are likely to continue for a little while to come yet. And then the kind of less good, profit growth is delayed, as well as being patchy. Defaults rise materially, at which point, again, we prefer credit over equities. We would expect volatility. And that's as the dance phase that I've touched upon, and to link that all back together, feels like shutdown for us all never ends. At which point we'd probably favour alternatives as well over bonds, because bond yields at the moment are incredibly low. And then we also asked our resident biochemist. There was a chap who, prior to this, was working in that specific sector. He's got a doctorate in the subject. He's quite a useful chap to have around. We asked him for the worst case, and that would be that the virus continues to mutate. It's really hard to get under control. Profits and defaults, therefore, remain uncertain. So therefore, we'd be underweight both equities and credit as an investment house. And then all bets are basically off from a fixed interest point of view as well. If I could say as to which of those, and I've rattled through those, I appreciate that we're kind of sat on at the moment. I'd say it'd be the middle two. If I could boil it down into 4 maybe bullet points as to what we think about those and our asset classes of choice. Coronavirus, I suppose, is a headline. We think the hammer is working. When we look at the numbers for the countries who've come down upon this hardest, it seems that they're able to revert back to some kind of normality. The dance, as I mentioned, will be hard, and we'll have to see how that goes in different countries and different approaches. The economic recession recovery will likely set records of both speed and size, as I've touched upon already. I think there are bargains for the brave out there at the moment. We're making certain changes within our portfolios at the moment, and we've recently been buying some credit based on some of the things that Stuart touched upon, and the credit spreads at the moment for investment grade companies are at the levels that we've seen previously for the high yield sector. So there's certainly some interest there, albeit obviously on a broadly diversified basis. And on a fixed interest point of view, we now know how far bonds can go, and not much further, arguably, based on where yields are. So a bit of a whistle-stop overview. Happy to cover off anything else, Stuart, you'd like me to.
Yeah, no, that's very helpful, Chris. I think, I think it's a moving kaleidoscope, isn't it, really?
Very much so.
Every day, the colours seem to change. So new information comes out.
Yep.
But clearly there are, as you said, bargains for the bold and brave. The key thing in all this, and we're advising all our clients, is it's about mindset. It's not about reacting and panicking. And there's a lot of seesaw movements, mainly the downward type going on. But it is a reset time, and it's very important that we keep perspective. And as you were saying, that there are bargains for the bold and brave. Remember the golden rule in investing. Warren Buffett is a massive fan of blood in the streets. This type of scenario where he's like, price is what you pay, value is what you get. And the golden rule in investing is there's only one rule, and that's buy low. And as Churchill said, let's never let a good crisis go to waste. We wouldn't have chosen it, but we find ourselves in this unprecedented time. So let's keep cool, calm heads. The only certainty at the moment is uncertainty, and let's resist being tempted to do nothing. And what we would say is, rather than do something, the key thing to do at the moment is to think through and assess your resilience and risk, review, rethink, and be prepared, and have market strategies that you want to deploy. We provide this investment advisory service to all our clients. Today isn't an investment advice program, but it's to say, let's think it through, and let's work it through together. And this gives me a great opportunity to bring Phil, who's sitting in our virtual office in London. So welcome, Phil.
Afternoon.
Take us through some, what should we be thinking about? What will we say to clients who are in this massive period of uncertainty and potential confusion, and looking at nursing some negatives, but others who are sitting there thinking, what can I do in terms of being more positive?
Okay, well, I just want to talk for 5 minutes or so this afternoon about some effective high-level planning approaches and the impact that COVID-19 has had on some other areas of financial planning. So for those in the market, or for those looking to invest in the future, we need to consider strategies. And firstly, we'd want to look at asset allocation. And asset allocation is the process of dividing your investments between different assets, such as cash, bonds, equity, and property. And this practice helps to spread risk through diversification. And it's therefore really important to consider if the portfolio is diversified enough, and how is it diversified? Is it just by sector, or is it by region as well? And importantly, does it reflect the right attitude to risk and capacity for loss? Because there could be an opportunity, as the gents have said, to currently increase equity exposure due to the perceived value. But is this appropriate to do? Is there the required capacity for loss for this to happen? And we also want to consider passive versus active fund management, because passive funds have become really popular due to low costs. But how do these perform in volatile markets? And consider whether fund managers add value by a more selective stock picking process. because in theory it could be easier to include or exclude equity sectors in the current climate, but beware of the Woodford effect, and remember fund managers are human and they're not algorithms. Also think pound cost averaging is very important at the minute, because pound cost averaging is a really good strategy in a volatile environment. And put simply, it just means setting up regular investment contributions rather than investing a large lump sum. And the advantage of pound cost averaging is that you don't have to spend time worrying about when you need to buy. When the market falls, you'll get more for your money. And when it rises, you'll get less, but your accumulated value will increase. And this means that investors don't have to worry about timing the market, which, as we've mentioned, is almost impossible to do. And reiterating Stuart's point, the myth of being able to time the market is just that. And from an investment perspective, the message is time in the market rather than timing the market. Cash flow modelling is very important in these times, and a cash flow model is a detailed picture of a client's assets, investments, debts, income and expenditure. And these are projected forward year by year using assumed rates of growth, income, inflation, wage rises and interest rates. And by modelling a range of different what-if cash flow scenarios and outcomes, you can see and understand the importance of planning for the future. So this may be when retirement will be, how much income or capital is needed, and it can enable the inclusion of shortfalls or the use of different asset classes. So pension funds, due to what's happened, they may not now be enough to meet expectation. So a later retirement date may need to be considered, or we may need to look at a blended approach with pension, investments, savings, or even using equity from the property. So I think the key message from this is the need to review current and future strategies. So in terms of other areas of financial planning affected by the current situation, we've chosen to highlight a couple, as Stuart mentioned earlier. And we'll start with the mortgage and equity release market. And there has been both a positive and a negative impact on the mortgage market. As Chris mentioned, Bank of England base rate has never been lower, and this has filtered down to the mortgage market, albeit quite slowly. However, lending has tightened, and that's despite the government's best efforts to provide liquidity. But this will hopefully loosen soon. But at the same time, mortgage providers are being much more selective and reducing loan to values, and in some cases actually withdrawing buy-to-let mortgages completely. And very important from a processing perspective, due to the lockdown measures, the mortgage market has got an interest with physical valuations, as these are just not currently possible to perform. But if you're sat and you've got a fairly straightforward remortgage, then there is a genuine opportunity to reduce outgoings by converting to a potentially lower rate mortgage product. And kind of leading on from conventional mortgages, we touch upon the equity release market, because the mortgage market to a certain degree also includes the equity release market. And there's definitely been an upswing in equity release interest, and you may well have seen more equity release adverts on TV than ever before. And the reason equity release is looking potentially more attractive is really linked to a general lack of current savings and liquidity and a current low borrowing rate environment. But this route needs to be fully understood, specifically regarding future inheritance, and there is still often the requirement for physical valuations. Looking at the protection market, I think clearly in a time of a global pandemic, the requirement for appropriate life cover is more vital than ever. And those that have life cover really need to look to ensure that that cover amount and structure is still appropriate. And those that do not have any in place really need to try and address that as a matter of priority. People are generally very aware of life cover, but other forms of cover such as income protection and critical illness are just as valuable. And it's also important to establish whether the use of trust planning would also be appropriate. So in terms of COVID impact, we're seeing larger sum assured cases experiencing the same kind of problem that the mortgage market is, in that these cases need medical underwriting. And this requires a GP visit or the life company sending a nurse to the client's home to complete the screening test, which, as you can imagine, is clearly quite difficult at the minute. However, as with other parts of the market, we are seeing innovation, and companies are starting to use remote medical screenings, which is really positive. And then lastly, just really want to touch on estate planning. And again, this continues from protection. And for the same reason that protection is currently so important, is the need to ensure estate planning is up to date and wills are reflecting current wishes. And those that have wills in place may have established them a number of years ago, and situations change over time. So it's really important to review and make sure that there's still those that do not have a will or a trust in place really need to consider establishing them as a matter of priority, because if anything was to happen and no will is in place, the rules of intestacy are followed, and these are very rigid and do not necessarily reflect distribution wishes. But I believe we'll have a webinar on Thursday where we'll look at that area in much more detail.
Yeah, I think that's very helpful, Phil. I just want to raise a couple of points there. Some of the advice we've given historically has been, manage your cost base, manage your expenses. Can I just say, do not cancel any assurance, insurance, protection schemes at the moment. That's critical. That's a critical payment that you don't want to be cutting out for obvious reasons. We all need to remember that we're not alone, and together we can find the right solutions and the answers, whether it's creating the vaccines, the testing kits, but also responding to the economic issues and the marketplace issues that this has triggered. We will get through this. It is a finite issue. So, just remember, keep calm and think value. It's about a positive mindset, even in the darkest moments. And it is a good opportunity to review and reset. And you may need to do some replanning in terms of your portfolios and your financial planning. We do have the time now, so please take full advantage of that, so that we're prepared not only to weather, but to come through this stronger than we went into it. Guys, any closing remarks? Chris, any closing remarks you'd like to?
No, just echo, I suppose, just to use some very well-versed lines and numbers just to support what you were talking about with regards to focusing on the plan. If we look back historically, and we have to try and control the reptilian fight or flight response in circumstances like this, particularly when we're greeted with nasty emails in our inbox and what have you about 10% drops, and we see vertical lines of the FTSE 100 on the television continuously. It plays absolute havoc with us. It's absolutely gut-wrenching. So if you've been invested, and we just look at history and maths for a second, because this is data and the logic that's able to support us in those moments. If you've been invested for 20 years, so that's 5,000 trading days between 1995 and the end of 2014, and you've remained invested over that whole period, you would have got from the US stock market about 9.5% return annualized. Clearly, it had gone up and down over that period, but 9.5% annualized. If you've missed just the 10 best days at 5,000, that's only 10 days, your portfolio's returns would have fallen to 6% annualized. So that's obviously losing a third of your returns just by missing out on 10 days. And then if we go further than that and say, if you missed 40 of the best days, your return actually goes negative. Now that's quite extraordinary when you think about it, only 40 days out of 5,000. But if I then add on top of that, that 6 of the 10 best days, those 10 best days that I mentioned that have delivered 9.5% return, occurred within 2 weeks of the 10 worst days, it paints a picture for us. And for me, that picture is always concentrate on your plan, and short-termism and reacting and listening to your emotions can be more damaging than anything else. So recoveries, as I mentioned earlier, can quite quickly follow market corrections. And I think, as Stuart's put very well earlier on today, try not to focus on those events and not to act, and perhaps just to focus on the longer term and what this is all about and value, as opposed to that knee-jerk reaction, will put you in better stead over the longer term.
Great. Thanks, Chris. Phil, any last comments?
Well, I just think that in this environment where we're all in lockdown, it's an opportunity for all of us to really ensure that we do what we can to make sure that our situations are as appropriate for this as possible. The real uncertainty with all of this is no one really knows the length of time this is going to happen, and clearly we will come through it. but the longer that happens, you know, the more significant the effect will be. So we just need to ensure that we review what we're doing and we're in the best possible shape to weather this storm.
Exactly. And I'd just like to say to all of you that join us, we are here. We're working as normal. You can respond to the 2 polls, and Adrian and Phil and the rest of the team were able to give you positive input on your planning, and we would just encourage you, this is an opportunity to review and replan where you are and where you want to be, because in the next 5-10 years you'll either be very grateful you did or very sad you didn't. So let's take the medicine. And no one wants to be in this situation, but we are where we are, and let's make sure that economically and financially we come out of this as best we can, and hopefully for some of us there will be some great bargains for the bold and the brave. And thanks for listening, and thank you, Chris, for your input. Thanks Phil, and Rosie, thank you for helping make all this happen.
Thank you, Stuart. And just to let everybody know what's coming up this week. So tomorrow we have, at the same time, we have a session on the legal and HR perspective on furlough. We've had a lot of questions around the furlough workers scheme and how you can actually get that up and running and what's going to come in the coming months. And then on Thursday, we have key steps to protect your family, your business, estates planning, wills and trusts. And for both of those sessions, we've got Acuity professional experts and also some external consultants and experts coming in. So I hope you can join us for those as well. Okay, thank you very much for joining today.
Thank you, guys. We look forward to seeing you again soon.